Alright, so we're in workbook chapter 10. Alright, so we're in workbook chapter 10, page 101. Alright, so we're going to do a little bit of a review here. Alright, so number 1 says a company's ability to pay its current liabilities as a measure of its blank. Liquidity. Good, good. Alright, number 2, debt management is a measure of blank, which is important because it refers to a company's ability to survive over a long period of time. I'm sorry, what? Good, solvency. Okay. Alright, number 3, the 2 most popular ratios for measuring liquidity are current and quick ratios. Alright. Number 4, the most popular ratios for evaluating asset management are accounts receivable turnover ratio. Good, average collection period ratio. No. I'm sorry, what? Good, inventory turnover. Good, fixed asset turnover. So again, when you're thinking asset management, think turnover ratios. So you got accounts, and remember, those 3 ratios are sort of evaluating that sales process all along a certain timeline. So when you're talking about the inventory turnover ratio, we're evaluating the process from the point that the inventory is delivered to how long does it take to get it out the door and get it sold. Then the accounts receivable turnover ratio picks up from that point of the sale to how long does it take to collect. Okay. All right, number 5, the most popular ratios for evaluating the solvency of a company are good, assets to liability and good, debt to equity. All right, number 6, the current ratio is also called the blank ratio. I'll give you a hint. We calculated this one at the end of the PowerPoint slides, but we just calculated it as a whole number. Good, working capital ratio. Good. All right. Number 7, if a current ratio is 2.87, it can be interpreted as there is blank of blank for every blank of blank. Now, I'll give you a hint. One of those blanks, the third one, is for every dollar. All right? So think, if we've got current ratio, what is the formula for current ratio? Good. So current ratio, I'm going to go ahead and write some of these on the board because we're going to use these here in a little bit. So we're talking about current assets over current liabilities. All right. So how would you fill that in words in number 7? If the current ratio is 2.87, so when we calculated this, that's what we got. So what we're saying is for every dollar in current liabilities, we have how much in current assets? $2.87. So if you want to fill that one in, number 7 should read, there is $2.87 of current assets for every dollar of current liabilities. Okay? All right. The quick ratio is also called the blank ratio. I heard it. Acid test ratio. Good. Good. All right. Number 9, if a quick ratio is 1.64, it can be interpreted as there are blank of blank for every blank of blank. All right. So again, it's just it's just like number 7. So yeah, right. So remember, when we're doing a quick ratio, remember up here for the numerator, we're only doing cash, short-term investments, and what? Accounts receivable. Okay, over current liabilities, right? So, what was the number that they gave us? 1.64. So if we end up getting 1.64, so what we're saying is for every dollar in current liabilities, we have good $1.64 in highly liquid assets. All right. So again, yeah. All right. So for number 9, if we get a quick ratio of 1.64, it can be interpreted as there is $1.64 of highly liquid assets for every dollar of current liabilities. Okay. All right. Number 10, if a restaurant sells only on a cash basis, including bank cards, its accounts receivable turnover ratio would be blank times. Think that one through. If we sell on a cash basis, I'll tell you what, let's back it up even more. What is the nature of accounts receivable? Right? It's asking us about the accounts receivable turnover ratio, right? So what's the nature of accounts receivable? We're selling on credit. So if we're only doing cash sales or debit cards, are we selling on credit? No. So therefore, the accounts receivable ratio would be 0.
Yeah, when you were at the first one.
Number 10.
So it would be 0 times?
It would be 0 times. Right. If we're selling with cash only and selling on bank cards, we're not selling anything on credit. So to have an accounts receivable turnover ratio, we actually have to book some accounts receivable at some point, and we're not. Okay. All right. Number 11. If a company has a credit policy of net 10 days on its billings, or invoices, if you want to put it that way, its average collection period should be about how many days? If a company has a credit policy of net 10 days on its billings, its average collection period should be about how long?
10 days.
10 days. That's so straightforward, it's throwing you off. Yeah, you don't have to do that. Okay. So again, number 11, if a company has credit policy of net 10 days on its billings, its average collection period should be about 10 days. Let me ask you a question. Let's take that one step further. If the credit policy was net 10 days and our average collection period ended up being more like 30 days, what should we do? Well, think about it. If our invoices say net 10,
So we still
but our
have 10
collect-
days.
yeah, if our policy is net 10 days, but our collection period is more like 30 days, what's happening?
You pay on the 10th day of that,
No. So if our think about what's happening here. If our policy is net 10, but when we calculate our collection period, we're getting No, they're not. Okay? So what should we do? What are our options?
Stop at this age.
Okay, we could jack up the interest rate, start charging them late fees and interest, that's a possibility.
Stop at 10 days.
Okay, keep going. Alright, we could change our policy to be a little bit longer to sort of coincide with what the customers are actually doing. That's also another possibility. There's one more kind of big one. Do we continue to sell to them if they're running late on payment?
No.
Maybe not. Okay. So we just have to evaluate that based on, what we think will work.
Wait, so what we say
10 days.
You have another example. Oh,
Yeah. I gave another example there. Yeah. All right. Number 12. The asset to liability ratio is also called the blank ratio. Solvency ratio. Good. Number 13. The computation of working capital is as follows. Blank less blank. And remember, less just means minus. Good. Current assets minus current liabilities. Right. Number 14. If current liabilities exceed current assets, a net working capital blank occurs. Deficit. Okay. All right. Okay, then the next part on that one just says write out the formulas. I'm going to assume that you can look that up and write those out. All right, so let's skip down to 10-2, where it says interpreting ratio results. Okay. All right, so number 1 says executive managers of the Degdon and Dale Hotels, Inc. have completed analyzing the balance sheet for the current period. Compare the results against the budgeted goals and provide a preliminary indication of whether the results are favorable or unfavorable. Do not consider any other factors but the ratio numbers provided. All right. Now I'm going to pull up some of these old PowerPoint slides. So the first one we have to evaluate is the current ratio. All right. So if we evaluate the current ratio, right? Current assets over current liabilities. So on this one, remember, a higher ratio is better. Okay? The other thing that you might want to make a note of is what's the lowest that this number can go, this ratio? Zero, right? The absolute lowest that this ratio can go is 0, because we may have 0 current assets to pay off however much in current liabilities. So,
what if assets been held like that? Because if you divide by 0, it's 0.
that's possible. That would look a little funky though, because that's going to be an infinity number, because we're dividing, or an invalid number, I think is what we're calling math, because you're dividing by 0. But lowest that this can go is 0. Okay? And then it can go as high as infinity, right? So keep in mind, current ratio, higher is better. Right? Higher is better. So if we go back to the current ratio, we had an actual of 2.9 and we budgeted 2.5. So is that a favorable or unfavorable variance? Favorable. Okay? Now, remember, when you're doing your analysis for the financial statements, get yourself into a mode of how do we approach this. So the first thing that we're going to do is we're going to go internal on the analysis of these ratios. So we'll go, maybe in this particular case, we're going budget. So we compare budgeted ratio with actual ratio. Okay? Then maybe we can stay internal analysis, and then we look at last year's ratio versus this year's ratio. Okay? So if you think, if we do budget versus actual, that's more of like a vertical analysis. Then if we do this year's ratio versus last year's ratio, that's more of a horizontal analysis. Then that pretty much wraps up internal analysis. Then we go external. So then it becomes how have we done compared to what the bank ratio says. Remember, the bank has a minimum ratio of 2. So on this one, we've got 2.9. So again, is that favorable or unfavorable variance? It's favorable. Bank requires a minimum of 2. We've got a 2.9. All right. What if an external analysis on this current ratio came in at all of our competitors are somewhere around a 3.1?
Wait, so we have to write this favorable now?
Correct. And now remember, the thing is, on the exam, you're going to get a set of financial statements, and then you're going to have to do a full financial analysis and tell me whether it's good or bad, favorable or unfavorable. So again, if all of our competitors are reporting in that their current ratio is a 3.1, we've got a 2.9, favorable or unfavorable? Unfavorable. They're doing better than we are. They're producing more cash and more current assets than we're able to, right? Okay, so it doesn't mean that just because it's favorable in this scenario doesn't mean that it can't go unfavorable for some other analysis, okay? Like last year versus this year, or an external, okay? All right, let's take a look at the next one. We've got a quick ratio. All right. Okay. All right, so we've got our quick ratio. Remember, this time, about the only thing that we're leaving out of this quick ratio is what? What are we leaving out? No, we're not leaving out receivables. Those are right there. Inventory, okay? So when you're talking about the quick ratio, we're basically leaving out inventory. Now again, what's the lowest that this number can go on a valid number? 0. And then it can go as high as infinity. So again, in this one, a higher ratio is better. Okay? So when we go back to the analysis, we've got a quick ratio of actual of 1.5, and we've got budgeted of 1.8. Unfavorable variance. Okay?
You want the budget, wait, which one do you, wait, if we have hold on.
We were shooting for 1.8.
Oh, but we made, okay, I'm looking
Yeah.
at it backwards.
Yeah.
Okay.
But again, remember, sometimes, depending on what the ratio is, lower is better. Okay? So in this particular case, higher is better. All right? So again, let's take this one step further. What if so with this comparison actual to budget, we've got an unfavorable variance. What if last year was 1.4? Then it would be a favorable variance. What if our competitors were doing 1.7? We would have another unfavorable variance. Okay. You getting the idea here? So it depends on what you're comparing it to. Okay, and we can have an unfavorable and favorable all in the same comparison here. All right, let's look at the next one. Accounts receivable turnover ratio. All right.
Isn't it favorable? Yeah, higher.
Well, let's talk about it first. All right. Accounts receivable turnover ratio. We're taking net revenues divided by average accounts receivable. So again, on this one, remember you need both balance sheet and income statement. Okay. Then it's going to give you the number of times during during that period that we turned it over. Okay? So, again, therefore, higher ratio is better.
So it's favorable.
Okay? Well, hang on. So let's talk this through one more time here. So accounts receivable turnover ratio, remember, number of times that we turn it over. So get an intuitive feeling here. If this ratio runs somewhere around 26, how often are we turning over our accounts receivable? Every, nope, 26 times per year. So 26 times per year is an average of every 2 weeks. Okay? Try to get that intuitive thought going in your head, because that'll be a really good check figure for you when you start calculating these. And if you get something a little wonky, you can actually fix it and you can check, catch it right there at the spot. What if our accounts receivable turnover ratio ended up being somewhere around 12? About every month, right? Every month. All right. What if our accounts receivable turnover ratio ended up being somewhere around 52? Once a week. Okay. So again, intuitively get this down in your head. Okay. Because if you know what's wrong and what doesn't look right, then you can generally catch yourself. All right, so in this particular case, our actual was 25.3 and budgeted was 15. So favorable or unfavorable?
Unfavorable.
Favorable, right? Because think about what we're looking at there. If we're looking at accounts receivable turnover ratio, if we budgeted 15, okay, then 15 ends up being 365 divided by, okay, my calculator doesn't want to work. Oh, come on. There we go. All right, so 360. There we go. All right, so think about what we had there. So if we've got a budgeted accounts receivable turnover ratio of 15, that means we were expecting a collection of every 24 days. Okay? All right, but we came in at 25.3, which means we collected every 14 days. So somehow we got everybody to pay 10 days earlier than what we had actually anticipated. Right? That's good. That means cash flow. All right, let's take a look at the next one. Fixed asset turnover ratio. All right, so fixed asset turnover ratio. Remember, when we're looking at fixed asset turnover ratio, we're trying to figure out how many dollars of revenues are we earning for every dollar that we have invested in fixed assets. So again, higher ratio is better because that means we're producing more revenue dollars for every dollar in fixed assets. So again, what's the lowest that this ratio can go? 0. And how high can it go? Infinity, right?
So it's favorable.
So, let's see, hang on, let me look back at it and see what our data is. Alright, so we budgeted 2.4 and we came in at 3.2, so that means we budgeted $2.4 in revenues for every dollar in fixed assets, and we came in at $3.2 in revenues for every dollar invested in assets, so it is indeed favorable ratio analysis. Okay? So whatever we did, we invested in something that produced some kind of really significant increase in what we thought we were going to do. Because think about what's happening there.
3.2 is supposed to be higher than 2.4. So
Yeah.
it's always supposed to be higher than 2.4.
Well, in this particular case, yes, higher is better. Okay? Everybody got it? Okay? Let's take a look at the next one, debt to equity. All right, pull that one up. Okay. All right, so we've got debt to equity. All right, so again, for every dollar in liability, or excuse me, for every dollar in equity, we have X number of dollars in liability. So a higher ratio tells us that the company is using more debt to expand the business. So is a higher number better or a lower number better in this particular case? Lower is better. Okay? So if lower is better, okay,
Then it's favorable.
good, then it is favorable because our budget was 1.5. So we were expecting $1.5 invested in, or excuse me, in debt versus every dollar invested in equity. We ended up with $1.3. Okay. So basically, what that tells us is we must have had some pretty good cash flow coming in, and we didn't have to incur the additional debt that we anticipated.
So
It's favorable. Favorable. Okay. So again, you've got to be careful here. Make sure that you understand whether lower is better or higher is better. All right. The next one, we've got an asset to liability ratio. All right, that's this one. Okay. So here, now we're evaluating how many dollars in assets do we have for every dollar in liability. Okay. So therefore, okay, total liquidity, higher ratio is better. Okay. So basically, I shouldn't use foul language, but you know, when the crap hits the fan, this is our ratio here. It's like, so if we had to shut everything down, how many dollars in assets do we have to pay off all those liabilities? Okay. So higher is better. It is actually favorable, just slightly. Okay. So we were anticipating $1.7 in total assets, but we ended up with $1.8 in total. Oh. There we go. That's all right. Remember, these are posted online after we finish today. All right. Any question there? Okay. Again, remember, full analysis. Go internal. Start with an internal analysis. Look at what was budget, what was last year. Okay. So again, think vertical, horizontal. What was the comparison against budget? What was the comparison against last year? Then go external. What's our comparison against what the bank requires? What's our comparison against our competitors?
So basically, the only one that you want to be lower is the debt to equity ratio.
In this particular group, yes, but go back to the PowerPoint slides. I want to say there's one. Hang on, let me refresh my memory. Let's see. There was one other one. Oh, the debt to asset ratio, the percentage. Lower is better there as well.
So debt to asset.
Mm-hmm. Debt to asset ratio. Okay. So there's two of them in this particular chapter that lower is better.
You gonna give us something like this on the test?
Oh, it's going to be real good because you're going to get a whole set of financial statements and you're going to have to will not be in this format. So hang loose. We're going to go over an example here in a minute. All right, so let's take a look at number 2. It says the results of a debt-to-equity ratio is 1.2 at the end of a hospitality corporation's current year. All right, so let's look at a debt-to-equity ratio. All right, so if we're looking at a debt-to-equity ratio, right, and we got, what would it say, 2.2? 1.2. All right, so we're saying that we equals 1.2.
Wait, a debt to equity, but, okay. You got 1.2, then what?
Okay, think about what's happening there. So we got a 1.2.
You got nothing to compare it to.
Well, hang on. All right, so it asks you 3 different questions against this one. It says, 1, or A, says state this result in the form of the financial accounting equation. Okay, the financial accounting equation is
Asset,
equals
liability,
plus equity. Okay, so if we have to list this in assets equal liabilities plus equity, and we got 1.2 out of, hang on. We got 1.2 out of this, right? That means for every dollar in equity, we have 1.2 in liabilities, right? So we plug 1 into equity. We plug 1.2 into liabilities, which means assets equal 2.2. See that? So if the result of this equals 1.2, that means we've got 1 in equity, we got 1.2 in liabilities, and we got 2.2 in assets.
How do you know it's always going to be, is it always going to be 1 in equity?
Yes, it is.
Or
In this particular case, when we're dealing with debt to equity ratio, any ratio that we get is going to indicate for every $1 in equity, how many dollars do we have in liabilities? So in this particular case, if this ended up being 5.5, equity would be 1, liabilities would be 5.5, assets would be 6.5. Okay? If we get a 5.5 on this ratio, that means for every dollar in equity, we have $5.5 in liabilities. So equity, if we try to put it in the assets or goal, liabilities plus owner's equity, we're still going to get 1 in equity, but now we're going to have 5.5 in liabilities, and we would have 6.5 in assets. Okay? The answer on the actual question on this one for A should look something like 2.2 in assets, 1.2 in liabilities, 1 in equity. Okay? All right, then it says restate this result using percentages rounded to a whole number.
what is going on with this extra stuff?
Okay? All right, now think. If we have to convert all this to percentages, I give you a hint. There's a common divisor here. What is it? To convert these to percentages.
Wait, if you're,
There's a common denominator. Nope.
is it going to be 1?
Nope. It is going to be 100, which equals total.
Percentage.
Yeah, I wouldn't say it, but I was like,
I know. I'm not going to bite you if you get it wrong. Okay? So in this particular case, if we need to convert this to percentages, assets become our common denominator. So that becomes, total assets become 100%, which then means what percentage do we have in liabilities?
Wait, do you do the 2.2 divided by 100 or backwards?
Probably, yeah.
So is it gonna be 22?
Alright, hang on. That thing's really. Alright. So if we need to convert this to percentages, the 2.2 becomes our common divisor, which becomes 100%. So then to get our liabilities or percentage of liabilities, we simply take liabilities divided by assets, and you should get 55%.
Wait, I missed how you did that.
The 1.2 divided by 2.2.
Okay.
Right? And then 1 divided by 2.2. So then if you come back and you get your percentages over here for liabilities and equity, if that does not add back up to 100%, you did something wrong.
Okay, wait. So just already just assume 100%.
Well, in this particular case, assets immediately become 100%. That becomes our common divisor. Okay?
Wait, because you round this up, right?
Yeah, I rounded it up to whole percentages. All right?
Okay, so where you get the 45 from?
It's the 1 divided by 2.2. Yep. So you took the 1.2 divided by 2.2 to get 55%, and then take the 1 divided by 2.2 to get 45%. So then the next question is, who's financing more of our assets, equity or liabilities? Liabilities. So we're borrowing more. Is that good or bad? That's not. Yeah, that's bad. Okay.
Okay, I get it.
Get it?
Yeah.
Okay.
Wait, is this another one just like it? Oh wait, let's say assets to liability ratio.
Yep. So this next one is assets to liability ratio. So if we go over here to this one, all right, so in this one we're taking total assets to total liabilities, and our ratio ended up being, what was it, 1.83.
It was 1.83.
1.83. So we're saying for every dollar we have in liabilities, we have 1.83 in total assets, right? So if we have to convert that to assets equal liabilities plus equity, assets become,
Wait, we gotta figure out what it is. No, wait, assets.
yep, you gotta convert that, you gotta convert this ratio. They're trying to get you to
Assets
see.
is 1.83. Liability is $1.
Correct?
And you gotta figure out what add those up, and that's the equity.
Subtract them. Okay? So if we had to convert this ratio to assets equal liabilities plus equity, assets become, like I said, 1.83. Liabilities become 1, which means we have how much in equity? 0.83. Okay? Then if we have to convert those to percentages, how much percentage do we have in liabilities?
Wait, it's 0.83, right?
It is. Okay? So if we convert that to percentages, we take the 1 in liabilities divided by the 1.83 in assets, and we get 55% in liabilities, which means that equity should be 45%, which, and again, the question is, who's financing most of the assets? Liabilities. Is that good or bad? That's not good.
Wait, is it always gonna be 55 and 45?
No, just coincidentally. Alright, so ratio in there. What if this assets to liability ratio becomes 2.5? What if this ratio, instead of being 1.83, becomes 2.5? Good. Equity assets would be 2.5. Liabilities would be 1. Equity would be 1.5. So stop and think. Is higher ratio better or lower?
Higher is better.
Higher is better because that means we're forcing more weight over here into the equity. Okay? Getting the idea here? All right. Okay. Part 2 says composition of working capital. It says compute the percentage composition of the current assets section of the BMAR Hotels Inc. from the information provided below. Carry your answers to one decimal place. Okay. Now, how would you calculate those?
Wait, ain't this like how we do with the other one? You take from the top of the pie, the decimal? Like, do cash by the total. So you would do divide everything by the total current asset.
Correct. Very good. So we're going to divide everything, each one of those items, divided by the total current assets. So what percentage do we get of cash? What percentage do we get of cash? No, not 5.7. Right, there's numbers. How do we calculate percentage of cash? Total cash divided by total current assets. So what percentage do we get?
You're gonna get 0.
Like 17.6%, right? Okay. We get how do we get percentage short-term investments?
Divide that by the total.
450 divided by 681. Okay?
Are y'all doing it without the zeros?
Yeah. Remember, you can drop zeros. Save yourself a little bit of time. You can drop all those zeros off there because they're all the same.
Oh, that one is gonna be like 0.66.
Mm-hmm.
The next one is like 0.5.
There you go.
Just show it.
I'm trying to make sure I show the answer, but I don't give you the answer to the next one. There we go. Okay, and again, all we're doing is we're taking cash divided by total, short-term investments divided by total, accounts receivable divided by total, inventory divided by total. The biggest thing here is a double check is when you get to the end and you finish doing this, go back and add these up to make sure that you come back to 100%. If you don't, you did something wrong. Okay. All right, the next one I think gets a little interesting. So, all right, I can't show all of it without giving away the answer first. All right, so there's your numbers.
Well, first, I guess you would have to add it all up to see what the total asset would be. So that you can do all current assets by the total asset. And then you have to do the same for liabilities. So it's gonna be like a two-part, thing.
two-parter. So when they're asking for the current ratio from the above information, remember current ratio, current assets over current liabilities, right? So we have to total up our current assets, total up our current liabilities. So you need to remember which ones do I include, which ones do I not include for your totals, okay? Because if this, you would include all of those, but what if that says what is the quick ratio?
Something about to go. Wait,
Yep.
the inventory.
The inventories have to go, right? Okay. So just be careful there, depending on which one it asks for. Okay. All right. Now, hang on, because I want to do something real quick here before we do anything else. All right. So in B, it says assume the management invests $20,000 of excess cash into marketable securities. What would be the current ratio then? All right. So let's think about what would happen with B. If we took some of that $30,000, right, took $20,000 of this cash and we moved it into short-term investments, okay, what would be the current ratio? Would it be the same or would it be different from A? Exactly. It would be exactly the same. Does everybody follow? Yeah. If you took this $20,000 out of here, that would mean cash would go down to 10, but short-term investments would go up to 20. Right? Okay. So nothing changes. Yes, ma'am.
Okay, so in the question, if it says excess cash, so even if it's excess cash, it's still included in the cash that's listed already? Like it's
Correct.
extra on the side?
Correct. Yeah, there's not anything extra out. There's not like $30,000 here and $20,000 somewhere else. We're taking it out of that account and putting it in there. So what we end up with come on. Is we end up with that, right? Nothing changes. We still have $53,000 in current assets. We still have $20,000 in current liabilities. All right. Now, read the third one. Instead of investing in marketable securities, assume that management pays all of, I think it was the accounts payable, right? Okay. So now, if we pay off all the accounts payable, now what would be the current ratio? So think about what we're doing here. We've got $9,000 in accounts payable. We take $9,000 out of cash and we pay this off. So cash becomes how much? If we do this, what's the new balance in cash? 21,000. Okay. And then what's the new balance in accounts payable? 0. Okay. If we take, instead of taking the cash out here and putting it in marketable securities, we take it out of the 30,000 and we pay off the 9.
Oh, it's still asking what the short investments would be?
No. Forget short-term investments. In the third scenario, we're taking $9,000 out of the 30,000 in cash and we're paying off those accounts payable.
Oh, if you take 9,000 from that, yeah, these are gone.
Exactly. So accounts payable now becomes 0. Cash now becomes 21,000, and you end up with this. So now we have 44,000 in current assets and 11 in liabilities. So does the current ratio change? Yes, it does. So we have to watch what we are actually changing there. So there's your ratios. So look at what happens. Again, remember, current ratio is higher better or lower better? Higher is better. So look what happened here. Instead of moving it in, out of cash into a marketable security, we still had 2.65 in the current ratio. Instead, we paid off debt. So not only did we reduce the numerator, but we also reduced the denominator. And it was a disproportionate reduction in the denominator. So we now have a current ratio of 4. So here's the scenario. You're getting ready to go to the bank to borrow money. You're trying to decide, do I move $20,000 into investments, or do I pay off $9,000 in accounts payable because I want the bank to I want us to look better for the bank? Which one do you do? Pay off the accounts payable. Because now your current ratio just went up to 4. Right? You look a lot better there. Okay?
I'm confused. Is that good or bad?
It's good. It's a lot better.
Because we paid it off, right?
Well,
Wait.
go back to current ratio. Hang on. Go back to current ratio. Right? We said current ratio, that's assets over current assets over current liabilities. Higher ratio is better. So if we move cash into investments, we stay at a current ratio of 2.65. But if we take $9,000 in cash out and we use that to pay off the accounts payable, now we end up with a current ratio of 4. So 4 is definitely a lot better than 2.65. All right? Okay. All right. Now, let's skip over 10.3 and let's go to 10.4. Okay?
Why you say 10.3?
It's at the top.
Yeah, 10-3. Skip over 10-3 and let's go to 10-4 on page 107. Okay? All right, so, and then what you might want to do is pull out page 109. Pull that one out, and then we're going to flip back and forth on page 107 and 108. All right? So the first ratio that we're going to look at is the current ratio. All right? So current ratio, what's the calculation for current ratio? Current assets over current liabilities. So what financial statement are we going to look at?
Wait, you said current ratio is what?
The balance sheet.
Current ratio is current assets over current liabilities. So we're going to look at the balance sheet only. Okay? So look at the balance sheet on page 107.
Wait, so only take out assets, well, current assets and liabilities. So when you skip all that other stuff, wait, you're gonna take out the inventory too, right?
No. Okay. Current assets over current liabilities.
It's up at the beginning of the year and the end of the year. Okay.
It's both at the end of the year. So here's the next question.
Just add up these totals.
Well, hang on. All right, so we're having to put together a current ratio. We're going to use end of year numbers. Okay? First of all. Second of all, we now need to figure out which year is in which column, right?
And which year?
So we're going to use end of year numbers. Okay? So what numbers are we going to pull off of that balance sheet?
25,000 and 13,000.
Good. 25 divided by 13.
How are we supposed to work this out with this little space? Wait,
Make it work.
oh, we work it out on this one? Oh.
Okay? So we're going to take 25 divided by 13. Now, what we wanted to compare that to last year, do we have the information that we need?
Yes.
Yes, we do. Because then, if we wanted to calculate last year, what numbers would we use?
1909.
Good, 19 over 9. I think it's because I made it so small.
Wait,
But I
so
can't get it.
1.9?
For the first one?
1.92.
Yeah.
You carried this, keep the two?
Yeah.
All this extra decimal shit, that's confusing.
Okay. All right. Now, did it get better or worse? What was last year's current ratio?
2.1.
2.1. How much is this year's?
So it's better this year than it was last year. It's,
Tell me.
it's
Is it better to have more assets per dollar of liability?
Higher is better.
So higher is better. So from last year to this year, did we get better or worse?
We got better.
We got worse
wait.
because it went down.
It went down,
2.1
not
to
up.
1.9.
Oh, so wait, y'all do this one to figure out.
Yeah.
Oh,
Exactly. You take 19,000 divided by 9 and 25 divided by 13. Okay? All right. This is a really good point for a break.